Welcome to our panel discussion, In It for the Long Run, the Role of Trade Credit Insurance in a Healthy Financial Supply Chain. So allow me first to introduce myself. My name is Scott Palis. I will be the moderator for this session, and I am a 25-year trade credit insurance veteran, both in terms of being an underwriter as well as a broker. I am with Willis Towers Watson, where I'm specifically charged with creating trade credit insurance solutions for AR-based financing programs, both in terms for our bank clients as well as for our corporate clients. Prior to me introducing the panel or letting them introduce themselves, let me first tell you a very quick pandemic story. So as I saw the vaccine creating a benefit to the spread of the virus, I took a very large global map, put it in our kitchen, and I handed my wife a dart. And I said, honey, for putting up with me this past 1 year, 3 months, 24/7, you take this dart, and assuming you don't throw it in an ocean, we will spend 2 weeks vacation wherever you can hit this dart. Ladies and gentlemen, in all sincerity, I am not looking forward to spending 2 weeks behind that refrigerator. All right, no more jokes. All kidding aside, we're now going to move on to our panelists for our panel discussion. I'll start with you, Sanjeev. If you can perhaps tell us, what trends are you seeing at Citibank with regard to insured trade finance structures? And maybe more importantly, what benefits do you see for both the bank as well as the corporate?
Hello, good afternoon, everyone. My name is Sanjeev Ganju. I am responsible for trade receivable financing for Citibank globally. I'm based in New York. I've been into the banking sector for almost 25 years and been in the trade product management role for past 15 years. So thank you, Scott, for inviting me into this distinguished panel. From the banking side, what we are seeing a shifting of trend, basically from a bilateral based receivable financing, whereby the clients' buyers were being individually assessed and selected for financing based on their risk profile, to more of a portfolio based approach.
So I'm guessing that shift that you're seeing from more of a singularity approach to a portfolio approach, is that to achieve off balance sheet funding?
Absolutely. In fact, the priorities have been shifting. Now, what we are seeing from the banking side, the priorities have been shifting towards off balance sheet structures, besides risk mitigation and DSO reduction. Now, just to add to that, corporates are nowadays looking to receivable finance as a way of repairing the damage which has been done to their balance sheet because of pandemic last year. And this is especially true, as the level of government support which was being provided to the governments in many countries starts tapering off. And based on the research reports what are coming out, we expect the insolvencies are going to increase by 13 to 14% this year. So as a result, we are seeing increased interest from corporates to secure coverage for their debtor books.
So not only are the corporates achieving the requisite funding, but they're also getting a source of risk mitigation through the process as well.
Absolutely. In fact, from again, what we are seeing is based on the interaction with clients, the return on invested capital is one of the key metrics nowadays being used by CFOs, CEOs, and the analysts. And the key component behind that metrics is the free cash flow. So therefore, your DSO, working capital efficiency, or the receivables turnover ratio are really getting priority. And in fact, if I talk about the key industries where we are seeing a lot of interest coming in is nowadays is from the travel and transportation, oil, auto, retail, and also the cross-border flows, wherein clients at one side wants to diversify, go beyond the domestic boundaries, but on the other side, they need to build some sort of a credit enhancements.
This makes perfect sense. So very quickly, let me go over to my underwriters on the panel. Sanjeev mentioned cross-border flow, auto, travel, transport, retail. Are these many of the sectoral-based submissions that underwriters are seeing? Let me open it up to the panel.
Yeah, Scott, I mean, we're certainly seeing interest there. I think, it's those are tough sectors, and they're starting to emerge out of the cocoon, as we say, from lockdown and so on. So we're seeing some potential opportunities, but those were hard hit. And I think people that were preparing with credit insurance going in had some success. People looking at them now are going to find a little bit less risk appetite for some of those sectors still, but it is starting to emerge slowly but surely.
Thanks, Kent. Jason, Jay, any further commentary from your side?
No, I agree with Ken. Sorry, Jay. They are definitely, they're sectors that are repairing at the moment, I suppose, coming back into the fore. They certainly have dropped off, I think, and from what we typically see in a typical year. I think you're more likely, we've seen a lot more, we've certainly seen a lot more food and beverage come through as those volumes have exploded up. We've been asked to take on a little bit of risk on some of the larger players who are bulk buying, trying to supply all of us sat at home, working from home and eating all our meals out of the fridge.
Yeah. All right. Well, thanks, Jason. So let me hand back then to Sanjeev very quickly. So Sanjeev talked at the onset about the benefits that you would see this providing to both the banks and the corporates. Can you go into what you feel these key benefits might be?
So, for the banks, by this portfolio-based approach, the key question is whether the banks have got the appetite to cover the entirety of the client's portfolio on its own. Possibly not. So what is the key strategy nowadays most of the banks are adopting is basically in terms to offset the risk is to basically get an insurance provider, which basically enables banks to to take on the corporate's entire network of buyers, irrespective of their size, currency, jurisdiction. And obviously through that approach, we are able to cover the entire portfolio for one particular client. And this not only helps in time saving, cost saving, but also from here, once we have an insurance cover, we are able to basically organize the portfolio into different tranches of risk.
Well, I would imagine, though, the key tranche, or the most important tranche, would be those particular buyers that would generate the greatest degree of utilization.
Correct, absolutely. And for clients also, this not only helps them to offload their entire receivables, but also provides financial flexibility and operational convenience. Now, clients can easily manage and transfer the risk while ensuring end-to-end coverage is being provided by their banking partner. And also it helps to improve the balance sheet ratios as clients are able to get a true sale opinion and hence achieve off balance sheet for these financings.
So they, summarizing, they get the risk mitigation and they also get the balance sheet repair. So they're getting funds, but not increasing their leverage ratios.
That's right. And the other benefit, what we are seeing is the banks with a global reach who have gotten access to large pool of financial institution investors can easily distribute these client receivables to these investors within their network. A service which was, not only increases the market for receivable finance, but also streamlines the process for corporates that previously used to go with the multiple banks to cover their entire portfolio. Now approaching one bank, a global bank with a global presence, they are not only able to achieve the entire portfolio risk mitigation, but also gives them access to the wide variety of financial institutions across the globe.
Oh, that's excellent. And I would imagine, and certainly know for a fact that we have created endorsements for those investor banks that will allow them to come onto a primary issued policy by endorsement and be called an insured so that those participating banks can actually achieve cap relief if indeed they're eligible to do so.
That's right.
Yeah. Okay. So Sanjeev, in closing, what do you feel the future holds for insurance-backed financial transactions?
Now, if I have to comment on that, if I look into the statistics which are available in the market today, let's say even after the pandemic hit us, the global trade flows, the trade in terms of the goods and services are somewhere north of 26, $27 trillion. And if I have to drill it down, the receivable finance is only mere $3 or $3.5 trillion. So, there is a huge space available for the growth for receivable finance business. And, as the economies try to come out of this pandemic, supply chains keep evolving, new jurisdiction, companies expanding into the new territories outside the local companies becoming regional, regional becoming global in nature. I think credit insurance receivable finance will continue to present a very, very effective and a very comprehensive way of optimizing working capital. And we are pretty confident of that.
So a question has come in from the audience, and it'll be directed to you initially, Sanjeev. But Jason, this is a topic you're going to speak specifically with regard to. And Sanjeev, the question is, has the Greensill implosion affected willingness for you to extend these type of programs and get credit insurance coverage?
No, again, I would differentiate how the banks operate, because banks have got their own stringent way of assessing individual client profile. We are very, very selective. Most of the banks are very selective in way how we underwrite credit. That is a very critical component of a differentiation between how banks operate and how fintechs operate. And I don't see the growth in receivable finance, that what I was mentioning slightly earlier, that there's a huge, tremendous opportunity, has got linkage to any of these fintech events which happened in Europe some time back. But generally, I think banks are in a pretty comfortable stage in the way they underwrite credit and how they basically work with the insurance to service their entire portfolio of buyers for their clients.
Excellent. Thank you, Sanjeev.
Thank you.
We'll now move on to our corporate panelists. So Pierre, what we would like to have you speak on are the credit team's review process. So theoretically, your best practices. What things do you do as a credit team when you actually have buyer risk that is deteriorating, either evidenced by a ratings decline or evidenced by very poor, slow payment performance? So Pierre, if you can kind of walk us through best practices and what you do from a credit management perspective with regard to your insured programs running your AR.
Hello, everybody. Thanks, Scott. Appreciate to be here. So I'm Pierre Kotmuller. I work for the GTR Group as a head of credit, and I'm also heading the operations. So let me start by the first key consideration or first principle. I think when we look at a buyer we want to extend credit terms, we looked at it as we were not insured. And probably at the beginning of the process, we definitely not insured, right? And I think that's a key consideration, because that's really the only way to avoid losses down the line, right? Because you need to feel comfortable first with the buyer. And then if you have insurance, it's even better. But the key word is acting as non-insured.
You just made three underwriters on the panel very, very happy.
I hope so. I guess I deserve a reduction in premium, right? Next year? Or not? Anyway, so I think it's also what's important is like to have a risk management culture within your company, right? And we're not only talking about the credit manager or the risk manager. We're talking about the entire company. I mean, coming from the trader to the management, to the back office and operator. And I think that's very important to explain to them how it works and how do we make sure we're not going to have a problem down the line. And I think that you also need to take into consideration and the fact of like, even if a claim is paid by the insurer, even if you are successful to get money from the insurance, the problem is you still have a cost. This cost can be direct or indirect, right? And by direct cost, I mean, you still have an uninsured portion of 10%, 20%, or more, depending on your policy, depending on the buyer, etc. Right? So there's a certain cost for a corporation if a buyer default. You have also like legal fees, recovery fees, which can be pretty high. But what a lot of people forget about in terms of cost is the indirect cost, is all the allocation of time of the management, of the traders, of the lawyers, of the internal lawyers, to basically trying to get money back, or to solve the claim, or to resolve the situation. And that's loss of opportunity. And that's difficult to quantify, but that's a big problem.
So you mentioned that you always act as if you're uninsured. So why are you paying for insurance?
I think that's a good question, but I think there's also an easy answer. I would split my answer in 2 points. I mean, the first point, obviously, as a trader, we need financing, and most of our financier or financial institution request coverage, or most of the time request coverage when we extend credit terms to some of our buyers. So the thing is a little bit of a vicious circle, because if we don't have insurance, we don't have financing. If we don't have financing, we don't have transaction. If we don't have transaction, we don't make money, right? So basically, you go back as the inception, you need to get insurance to live to a certain extent, right? The second point is very selfish. I like sleeping overnight, right? And it's still good to know you have somebody protect you if something goes wrong. And I think, you know, it's not because the fact is, like, we can see for the last 20 years, right? There was a couple of black swan events. I mean, there was a financial crisis in 2008. There was just recently a pandemic. And during these times, even if your buyer is a very good buyer, is a very good customer, and he's been acting very, very well for the last 10 or 20 years, just because of this reason, he may become a less good payer, just if I can explain this way, right? So it brings a mitigation tool to against, like, rainy day, if I can express this way.
Excellent. So if we look at all of that, maybe perhaps take a minute to talk about your actual credit management processes. So what are the things that you do? What are the best practices engaged on that you're looking at from a credit management perspective when working with these buyers?
So I think what need to be understood, is like the approach is risk-based, right? You're not gonna have the same approach if you look at like a Moody's a company than if you look at a private company of very small in the different industry, depending on the industry, depending on the country, right? So I would like to say every customer is equal, but actually it's not very true, and customers are not equal in the credit process. So the credit process, management process is really a multi-step process. It's also an ongoing process, right? It's not a one-off process. You do it, you're good for the next 2 years, and you can sleep, or the next year you can sleep, right? There's like continuously monitoring, which is also risk-based to a certain extent. So, but what do we include in the credit management process? I mean, first, fortunately, unfortunately, is what we call KYC. I mean, know your customer. I mean, for two different reasons. One, from a compliance point of view, because obviously you have different issue by dealing with certain buyers, and also to understand the structure of your company. After that, you have your credit analysis, and your credit analysis include different steps, right? I mean, the first step obviously is like analyzing the financial figures, but these financial figures need to be put into context with industry, country, macro and micro environment. I mean, also past transaction. How well do you know your customer? How many times did you transact with the customer in the past? And also you need to put into perspective what is the payment terms. It's like 1 year payment terms, 90-day payment terms, etc. Right? So I mean, and the next step, obviously, when you agree, everything is nice. I mean, you're in agreement to give terms to your customer. It's when starts the monitoring process. monitoring process at two levels, right? The first level is a review, right? Is your customer customer credit rating is downgraded by 2 notch? What is the reason? Is it creating a risk for you? And the second level is a transaction monitoring. Is your customer paying? When does he pay you, etc. You can go to the next step, and I think is a collection process, but we prefer not talking about it because we don't have problems, right?
Yeah,
So,
good. So let's touch on that for just a moment, right? I won't let you off the hook completely. So if you see that buyer deterioration, right? So whether it is that double downgrade that you just mentioned, or you've got significant past dues that are being noticed with regard to the aged analysis, what do you guys do? What do you do with that defaulting buyer or deteriorating buyer, I should say?
I think, again, like every situation, every customer is different. But I think there's 3 key fundamentals. And the first one is obviously when you have a problem or when you have a buyer which deteriorates in terms of like a payment or credit worthiness, you basically need to have a discussion internally. And not only with the trader, but with traders, back office, senior management. And that's important, everybody is aware. There should be a risk awareness. And that's back to the risk management culture we discussed before. The second point is basically obviously discussing with your external stakeholders, which can be obviously if you finance a transaction, can be your financial institution. But also, if you're insured, they need to be your insurer, right? And the third point, which is I think very important, is like you need to reach out to the management of your buyer. Okay, so basically trying to entertain a discussion to understand what is the issue, how can we solve the issue.
Yeah.
So
to me, it sounds like your overriding theme is communication. I heard communication internally, communication with your stakeholders, communication with senior management. Sounds like it's all about communication.
I think it's definitely correct. So,
Excellent.
so go ahead. Sorry.
I was just going to say, any closing comments from yourself? Any last summarizing thoughts?
I think like mistakes are gonna be happening, right? I mean, everybody makes mistake. I try not to.
Not you, Pierre.
You know, as I said, I mean, I'm Swiss, so my coverage is 99%, slightly higher than by what my insurer are providing me. But anyway, we're gonna make mistake. I think what is important is trying to learn from your mistake, right? And trying to improve, continuously improve your credit management process.
Thank you, Pierre. Before I hand off to now the 3 underwriters on our panel, we have had a series of questions come in. I think this first one will end up going to Sanjeev. And the question is, Sanjeev, how would you balance competing solutions that come into the bank via different teams? For example, ABL with buyers, with the buyer buying insurance and assigning it to the bank, or supply chain finance with the bank being the insurer. So the question is, how do you balance when there are competing solutions coming into the bank?
I think that's how the bank's internal teams are structured, right? Whether it's an ABL-based transaction or a supply finance covered by insurance, or is a receivable finance covered by insurance, or there's a receivable finance covered by an EXIM agencies. So these are different teams within the banks, which we basically analyze each of the structures depending on how the risk parameters are set, how the internal norms are decided for each product, right? Because these fall within different buckets, and within the bank, within the trade overall boundaries, we have our own risk acceptance criteria, which defines the product standards, under what standards we can offer what sort of a product to a particular client. But again, it also depends. Not only we just take it on its face value, but we need to understand what sort of a product makes more sense for a client. Even because many times we have seen clients coming with a particular request, but then once we sit with them and understand their overall requirement, these things do change. these things do change, and then we try to basically offer a solution which fits more to the clients rather than what they might have thought from the original perspective.
Makes sense. And back to what we were just speaking a moment ago with our communication.
Yes.
Yeah, thank you, Sanjeev. And maybe a very quick question to the underwriters. In terms of receivable finance, how do we mitigate the risk that utilization ends up lower than expected and higher premiums ultimately than are paid? Can there be any revenue share structures, or are these no longer available? So this would be applicable for my my underwriters to mention.
I'll start on that one. Yeah, it's an issue that is ongoing and frequent. A lot of times, it's a new portfolio, it's a new business opportunity. Utilization is not known. So we recognize that we are coming into this together. We are setting certain expectations and estimates out of the gate, and they may not materialize. So I think the first year is a trial period on the facility. And so, yes, there is the goal of having an appropriate fee in place. And if, it turns out that utilization was way off, are we still committed to carrying millions in cover where utilization is non-existent? So we want to, check in periodically to make sure that everything is on track. And if it is not, let's figure out what should be done to fix it and make it right.
Excellent. Thank you, Jay. So let's now move to our next panelist. The question is to you, Kent. What typical steps do you undertake when underwriting a bank as the primary insured as opposed to a corporate?
Thank you, Scott. And
and certainly give your bio as well.
I will. Kent Paisley. I'm with Allied World. I head up the short-term trade credit products for our team, which is primarily based in North America, although we do some international activity as well. Been in the insurance industry, credit insurance industry, for coming up to close to 30 years. Like Scott, on the broker side and on the underwriting side. So I've had both sides of the house. Mostly on the underwriting side, and that's where I reside right now. We've spent the last little while building a nice book over the last 5 or 6 years with an emphasis on trade finance, both at the corporate level and the banking level, and have spent a lot of time developing wordings, et cetera, to create I think a solution that hopefully most of our clients seem to like so far. So we continue on in that vein. With that in mind, I think there was really a couple of important things that have been said both by Sanjeev and Pierre today is communication, but really the most important part of that is their due diligence. When we go in to do initial bank financing type deal, we're going to do our due diligence as well. But the due diligence we're doing is on the bank, the financial institution, and corporates for that matter as well. But I'm going to focus mostly on banks here. Is, we want to know, how do you assess your customers? How do you monitor your customers? What are the processes that you go through to manage from the new client right through to the client that has the, God forbid, Pierre, a claim, a slow pay situation? What do you do to what do you do to manage and monitor that process? So we spend a good bit of time up front to make sure we really understand how our potential client manages this process and how they onboard. The other side too is ensuring that I think we touched on it earlier on about sectors and so on. We do spend some time ensuring that we're comfortable with the sectors that they are looking to be very active in as well. That due diligence involves a number of things. What processes are in place? What are they doing in terms of credit due diligence? If they have internal rating systems, how do those work in such a way that we can get comfortable with that process? And then one of the most important parts is reviewing the wording and the interaction between typically a receivables purchase agreement or other similar document that the bank will use with their client, and then how that dovetails nicely with the insurance policy. The insurance policy is an insurance policy, the RPA is an RPA, and they need to do their individual jobs, but they do need to link together. And then the other piece is we look at the deal from the standpoint, does it stand on its own 2 feet? is insurance is not insurance isn't a fix. Insurance is a solution to turn around and help make certain things happen. As Sanjeev touched on earlier, maybe a broader portfolio. As Pierre will say, maybe it opens up a new market for them or allows them to extend the terms of payment, make them more competitive. We want to make sure that we're looking at. We're not going to turn a B- credit into a triple B credit because you got credit insurance on it. It's still a B- credit, and so we are here to build a structure that's supportable. The important part for all that is the due diligence at the onset with a specific client is really a little more lengthy than maybe a standard trade credit application, because we know with the hope would be is you're building a number of different transactions over time, such that you've done that upfront due diligence. You're able to then be more effective on a timeliness basis to individual transactions as they come about. Our experience has been that with our bank clients is that they when they've got a deal coming to market, it's usually got some time sensitivity to it, and we need to be able to respond. And with that time sensitivity, we still need to do our due diligence. But because we've done our due diligence on our corporate or our bank in this case, we're comfortable with how they do the process. Now we're looking at the nuances of this specific deal: sector, risk, portfolio, structure, etc.
So,
Yes.
so a question did come in from the audience, and I think it's apropos to what you're talking about right now, Kent, and maybe perhaps it can be highlighted even from all of the other panelists. But what does currency risk play as a role in decisions and how the panel views credit risk? So they're talking specifically about currency risk. How does that come into play for you?
So we're an insurance product. We protect against the non-payment. We don't get involved in currency risk. Having started my career in foreign exchange with Citibank as my primary banker, with all my currencies around the world, the banks are very well placed to manage foreign exchange risk. We are there to facilitate the need in terms of onboarding different AR and that sort of thing. But really, we're not going to get involved in the currency risk. That being said, in some of the due diligence we do, we will look at what impact that might have on a potential payment situation or scenario. So we won't hedge the risk. We'll certainly take it into consideration when evaluating that risk.
So maybe over to Sanjeev or for Pierre, does currency risk come into the equation in your credit risk analyses?
Yes, so in terms of currency risk, typically, when we do these sort of a products of an insured backed receivable financing, we try to match the discounting currency to the insured currency. Now, sometimes we do get a portfolio which has got a mix of currencies, but we try to basically move towards the insurance coverage, covering the maximum particular currency rather than having a multiple dual currency sort of an insurance policy, right?
Yeah,
so that's always been our approach.
Yeah, okay, thank you. Thank you, Sanjeev. So Kent, back to you, and maybe to kind of finalize this discussion, what caveats do you think are important for both banks as well as corporates to investigate when they're considering trade credit insurance? So what kind of advice can you give to banks and corporates as they investigate the product?
Well, evaluating it is the first litmus test is the transaction sustainable on its own in some form or another? Maybe you can't do it as long terms. Maybe you can't do the volume you might be comfortable with, but the underlying transaction is sustainable. And that's an important first step. And then the other aspect of it is does it make sense in terms of the risk profile that you're looking to build into your overall book? And can credit insurance help you fill some of the holes there that you need to be able to make the deal more effective for you, your client, and give you the impact that you're looking for? As Pierre mentioned, cash flow is king. Sanjeev's business, that's what they do. Jay and Jason and I, are ensuring that on a daily basis. Does the credit insurance facilitate a more effective cash flow scenario?
Excellent. Thank you, Kent. So now we're going to move over to our second underwriter on the panel. That's Jason LeGroux with Chubb. Jason, if you would give your quick bio, and then if you could address for me, following very highly publicized news on a supply chain financier / bank insolvency, how does Chubb now look and underwrite for supply chain finance transactions?
Hi, Scott. Thanks for having me today. So I'm Jason LeGroux with Chubb's Political Risk and Credit Department. I've been with Chubb for 10 years now. I'm part of the Global Receivables and Supply Chain Finance team, and also tasked with North American business development. Scott, I think going back to that, not only the question you've asked me, but the earlier question, this hasn't changed the way that we underwrite supply chain finance.
Right.
I think in many ways it's probably reinforced our fundamentals, the way that we do underwrite it. I think it's probably fair to say we are in an industry that's insuring against bad events, effectively non-payment. It's hard for us to have knee-jerk reactions to things that happen in the market and then be blown by wherever those winds take you. You know, what our clients want is consistency from us. They want to know that in the event that things go wrong, we're going to be there standing next to them. So for us, I think consistency is key within that, and therefore sticking to our principles is very much the way that we go through that. You know, as a 20-year market that's now a global operation around the world, you know, we set up the receivables team effectively to have a consistent approach and probably allow us a consistent communication, particularly with our clients, our multinational clients around the world, knowing that we service different parts of a bank in different regions. We want them to be able to know that wherever they are, whenever they come to Chubb, they get the exact same response, because we're all communicating the way that we should do. And yes, it does always come back to communication. I think, you know, we're getting to a point now where the market, both supply chain finance market and the insurance market, are very competitive. There's new capacity coming online, new entrants. I think there is, you know, as Kent spoke to, there is a time sensitivity when you're pitching for deals. When you're, you know, your client needs an answer quickly, and they need to be able to go back because they need to be able to put their best foot forward. Now, we are there in many instances to help grow their business by being their backstop. But I think when you're pushing in those short timelines, it's very easy to sometimes overlook some of your fundamentals, and therefore focus more on trying to get a good risk or a good portfolio of risks onto your book, rather than working through the structured underwriting that I think you need to have when you're looking at this business.
Excellent. So a question has come in, and it's relevant to what you're speaking on at the moment. And they're asking, does the Greensill case indicate that supply chain finance may have become over-reliant on trade credit insurance, or is this simply a case of malpractice with regard to the product?
I think, you know, when we're looking at supply chain finance, I would probably say that it's not a case of a broken system for sure. It is. I think that's one instance. It's one anomaly within what is and as Sanjeev spoke to earlier, it is something that is very useful. It's a tool for a lot of clients that we as insurers, I think, are there to help with the process. I think we talk about partnership a lot when we work with our clients, and I think there's certainly no reliance on us. I think we've become part of the necessary DNA of the way that it's run. You know, I think we work hand in hand with our insureds, and a lot of that is through, you know, as Kent talked about, as Pierre talked about, it's our due diligence. You know, you work through it, you understand who your client is. It's the fundamental rule number one of insurance: know you're insured. Once you've been able to go through that and identify their business, how they go about their business, then you've set your foundation to be able to grow that relationship. You know,
maybe if you can, on the aspect of KYC, maybe if you can quickly talk about that level of diligence within the receivable purchase agreement. How far do you dig into that document when you're establishing your cover?
Sure. Kent highlighted this in his segment. You know, it's the document that goes hand in hand with our wording. It doesn't replace our wording, but the two of them should come together nicely to create a seamless, almost dovetail together, so there are no holes in coverage. I mean, in terms of what we're looking for,
Yeah,
we
you
are
certainly can't have the policy define loss in one way and have the RPA define loss in another. It would be a
that's how
mismatch made in hell.
it's how the whole thing falls apart. You know, when we're looking at the RPA, we're looking at the enforceability of receivables. We're looking at does the servicer or the insured, being the bank, have the rights to be able to affect the legal transfer of the receivable, the ownership of the receivable.
Yeah.
We're also just within and through that document trying to ensure that it's not a convoluted structure. You know, the RPA sets out the terms between the seller and the insured, or the servicer and the insured. We as the underwriters want to be assured of our subrogated rights or the assignment that we have under that agreement, and also know that we've got the rights within that if we needed to direct the servicer to take some remedial action, that we can do so through the insured, again touching upon that communication. And then, you know, a few points that we specifically look for are clear termination provisions between the two, terms that allow for monitoring of the performance, going back to what Pierre was talking about, terms that oblige the seller to consult with the insured and therefore the insurer on loss mitigation, clearly define recourse events, whether that be through disputes, unenforceability, or breach of warranties, and then clear rights for the insured, if necessary, to step into the servicer's shoes in the event that the servicer was to go insolvent.
Excellent. Any final comments, Jason?
I would just say that I think a lot of what we've seen in the past year, and particularly through the pandemic, is a rise in need for open transparency and communication, open lines. You know, when you're trying to mitigate against these events, and events being non-payment claims, losses, you just want to be able to have that sensible conversation. Not every risk is equal. Not every event is equal. They have to be treated differently, and you have to be able to adapt the way that you approach that. And you only do that by talking to each other and learning about the whole situation. We talk
Communication.
Indeed, Scott.
Thank you, Jason. We're now going to move to Jay Leclerc of Euler Hermes. Jay, if you wouldn't mind giving your brief bio, and then what I would like you to talk about are any common themes that you're seeing from a Euler Hermes basis in terms of where you see bank focus. So Jay, take it away, give us your bio, and then talk about common themes you're seeing in the marketplace.
Thank you, Scott. Pleasure to be with you all today. My name is Jay Leclerc. I'm the Region Director for the Euler Hermes World Agency. I am based in New York, and my team is in place to support the global needs of our multinational clients as well as our global bank partners. A common theme, there are several, Scott. When we look at consistencies, one of the biggest common themes is cost. It is an added layer into a facility, and so we are ultra sensitive to that. And when we look at cost, we also want to propose that while taking this on, there are expenses that we are taking away that the bank does not have to be burdened with by reducing their due diligence, by reducing their own internal underwriting processes, allowing our credit intelligence to be their risk underwriting and risk assessment approach, reducing their administration, human capital, our credit intelligence on access to 60 million companies worldwide, capital relief, lowering of bad debt reserves, reducing cost of funds, borrowing costs, et cetera. So while there is a cost, there are an enormous amount of enhancements and benefits. The approach that we take is really, and I want to also thank Kent and Jason for doing most of the heavy lifting. They covered a few important areas that I might offer a nuance to. So I'll thank those two gentlemen. And I don't want to repeat some of the points they made. We recognize this is an ultra competitive environment. We look to enhance and provide our bank partners a more robust competitive edge, a platform to enhance their offerings, to help them retain long-term important clients, to increase their value proposition, both with their current clients as well as they look to grow their business. Our discussions with our banks are important because we may have banks that are new to a particular sector or marketplace. We may have banks that are targeting more middle market, higher risk portfolio business. Time sensitivity. Our banks are competing. They must be always moving as quickly as possible. And because I have zero patience, we seem to have a good ability to get back to our bank clients with a very compelling level of detail and guidance, the good, the bad, and the ugly. And this is what it's going to cost. Does the deal have legs? Do we support some of those challenging buyers? Can we agree to the payment terms, to the particular structure that I must say our broker partners continue to push every damn envelope we have. So keep up the good work there. You make us smarter, or at least everybody except for me, Scott. So I thank you for that. When you look at this portfolio, and I will give you our best information, but there are cases where we're going to decline. It's not anything. It's that old term. It's not you. It's me. We're not going to step up on some of the key limits. It's a messy portfolio. It's challenging. And we have our own internal criteria that we must bring value to both our partners. And that includes the broker. But ultimately, when we take the cost, when we can strike the wording and have an agreed wording in place, and we can enable our clients to access our information, whether it be on one buyer or 200, and we can enable them to compete, and they can reduce their internal costs and external costs and due diligence, transferring that portfolio from whatever to a AA rated insurer. Do they now have an investment grade portfolio where they have greater access to capital at lower cost and reducing their bad debt reserves? So those are some of the common themes.
And I think very well said. We're approaching the final minutes of our panel, and I do have a number of questions that have come in. So we're unfortunately not going to get to them all, but one of them is, how does Citibank monitor their clients and ensure that claims are avoided? So Sanjeev, this one's over to you, and it may be relevant for those listening on the panel discussion for you to comment on how you monitor clients and ensure that claims are avoided.
I think that's a good question. I think this has got linkages, right? Not only the post disbursement, but I think the pre-disbursement, which Kent and Pierre mentioned about the due diligence, right? When we start with the client, obviously there's a lot of efforts put in. And as Jason mentioned about the DNA, which I really liked it, because this is really, in-depth due diligence is required when we onboard any client for insurance. And then the second part is, banks just by taking in insurance does not mean I am relieved of all my responsibilities. No, I work with broker and insurers in hand to hand as if the deal is not insured, because it's a moral and social responsibility on behalf of the bank to ensure that we are working with our partners like insurers on the panel to ensure whatever the coverage they are providing, we are basically able to justify in terms of doing a proper due diligence and monitoring. Because when it comes to monitoring, that is the post-disbursement side of the deal, there is an extensive effort and there's a lot of scrutiny, controls, and governance being put in from, at least from the bank's perspective, I can say. to ensure that there is a clear monitoring of a daily flows, the repayments, any past dues from any buyers for any reason, and if there is a deemed dispute or a commercial dispute, how does it link to the repurchase events in the RPA? All these things are very, very scrutinized very closely. So we spend a lot of time on the monitoring.
Excellent. So at this point, we are going to thank GTR for establishing this panel discussion. And my heartfelt thanks to my 5 panelists who have joined, to Sanjeev, to Pierre, to Kent, to Jason, and to Jay. Thank you all. And GTR, thank you for allowing us the opportunity to speak. So at that, we'll close our panel discussion and have a wonderful rest of your session. Goodbye,
Thank you so
everybody.
much. Goodbye.
Thank you.
Thank you.